You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means it is Wednesday yet again. Time to roll out the old drill instructor proving ground, our hats and our whistles in hand for a little bit of Options Bootcamp. My name, of course, Mark Longo from theoptionsinsider.com, as well as from the network upon which all of you folks are binging not one, not two, but three new shows hitting the network over the last 6+ months out there, including one just a few weeks ago. So now you have an embarrassment of riches, the futures rundown to check out, as well as the European market brief. That latest episode, just recorded it yesterday, should be hitting the network any second. It might be hitting as we're speaking. And then, of course, the hot options report coming at you every day. Our pro members have already heard all of that fun stuff. So if you want to join them, and of course, join them in winning fabulous prizes like our pro member did, Mr. Unlimited, just won the July Pro Trading Crate on Monday, so congrats to him a second time. So you can be a multiple-time winner. We don't cut you off at one. If you're in the pro, you're in it to win it, baby. So get on over there, theoptionsinsider.com/pro. Get your name in the hat for the August Pro Trading Crate exclusive shows, early access to stuff, live streams, giveaways, oddities, pro Q&As, on and on and on. You could draw your own caricatures of Dan and send them in. We have our little fridge here in the studio. Put them up right there. It's all really good stuff. Theoptionsinsider.com/pro is the place to go to learn more. And since I have unfairly maligned him already, let's bring him on now for a little rebuttal. None other than the black-hatted one himself, Mr. Dan Passarelli from Market Taker Mentoring. Dan, we weren't live last week, but now we're back and raring to go. How are things in MTM? And more importantly, all the kids wanted to know, did you miss me, sir?
Things are good in MTM land, and I didn't realize you were gone. Were you gone? Oh, well, yeah, okay.
You know what, Dan? We get fun questions here all the time. Sometimes they fall outside of the regular scope of a basic training or even an options drill sometimes. We got a fun one like that this week. So I guess we'll get into a little bit of the old mail call.
Mail call. Time to look at questions submitted by our listeners.
All right. Let's dive on into a little bit of the old. It's not basic training, Dan. It's not even really an options drills. It's really more of, I guess let's call it exotic training. How about that, Dan? Does that sound good?
Oh, yeah, that sounds pretty exciting.
All right, because we have a question here, and this is a topic I was thinking about broaching as well, and just happened to coincide with a question from a listener, because I saw the same article he was referring to. This came in from Marcus. He says, "Hey, OBC, I saw this article and I wondered what you guys thought about this. Is this activity actually prevalent? And he sent a link to a Bloomberg article. And the article, if you want to find it for yourselves, listeners, is just called Traders Hedging Stocks at Record Highs, Dabble in Exotic Options. Dan, have you seen this article, sir? If not, I have a synopsis here for you.
I'm going to need the synopsis. I actually have not seen that one, and I read a lot of the Bloomberg articles.
All right, let's get into it then, listeners. So essentially, it's an article about people. Obviously, markets are rallying. People want protection, and they're looking for a way to do it. Obviously, they don't want to throw money just on puts because we all know the issue with puts. If you buy a put and the market continues to rally, guess what? You're out of luck. And then also, sometimes if the market slowly drops, you have issues there as well. There are a lot of issues with puts on top of them being expensive and everything else. So this article from Bloomberg here talks about people looking for over-the-counter alternatives. And they highlight a bunch of different scenarios. And I'm not going to read the whole thing for you, listeners. I encourage you to go check it out for yourselves. But they mention that UBS Group and JP Morgan Chase, they have recently recommended so-called look-back or resettable put options, where the strike follows the market higher, and in the case of look-back puts, is set at the highest closing print during the life of the trade. These are currently trading at a historically narrow premium to vanilla puts, according to this JP Morgan strategist they talked. They also talked to someone from Citigroup. He says hedging is a big deal right now. Obviously, we've seen decent buying flows in the look-back put, as it is cheap by historical standards, since the value of the look-back feature is a function of implied vol, which is low. So there might be something to that there, of course. Implied vol being low does mean that premium could be lower. You're still going to be paying for this, listeners, so just bear that in mind if you can even get it, of course. This is not really for your mom and pop retail, which is, again, not a reason, or one of the reasons, I should say, why I didn't really bring it up on the show right away. But when you folks ask, we must oblige. So let's keep on rolling here, listeners. They say look-back put implemented from market high, they say here, would have shifted the strike of a 2-month put at 95% of the spot level, 3.4% higher on average over the past 10 years. That goes back 10 years. It's a long period. The look-back feature, they say, only costs 0.4% more than the vanilla put. And I find that hard to believe. I haven't gone and priced some look-backs myself, but they're giving you very optimal payouts compared to a plain vanilla put, listeners. And they're saying it's not really costing you that much more money. They point out, as we say here, the optimal scenario, you buy this, market rallies, then collapses, so you get the payout on your put. Obviously, that's the case with traditional puts as well. And in those scenarios, the payouts can be dramatically different between these exotic options and your standard vanilla options. Let's look at some examples here, Dan, for the folks. Again, it's called a look back because it allows you to effectively look back to the optimal price of the underlying during the option's life. So that's a nice thing. Think about that, listeners. If you can buy a put, and let's say you buy a par put in a stock that's trading $100, and then it rallies to 150, and you're still stuck with that par put, you might say, man, I would really wish I had a 150 put instead. Well, that's sort of along the lines of what a look-back put is giving you. Now, of course, you're going to pay for that, so just bear that in mind. They say 0.4%. I have a feeling it's a wee bit higher, but that said, well, let's get into some of the examples here for you. There are two flavors of these look-back options. There's the floating strike, and that's what they're talking about in the article, I do believe, as well, where you buy a put on a stock, and the strike is fixed at the expiration of the option there. So you get kind of the max strike, which is a great thing when you're looking for protection. And then there's a fixed strike where the look back is actually based on the lowest the underlying got. So kind of doing something similar, but going about it a different way. Let's look at an example here of your look back put where the strike is not fixed. So let's say you have an example of a stock, listeners. You own it. Stock ranges between the lifetime of this put between $80 and $120. So 40 handles, 50% from the low. That's a pretty big move in the stock. Let's say you come in and you hedge with a regular put. You buy your traditional, let's say, par put for whatever the outlay is. And let's say the stock, after going from 80 all the way up to 120, settles back down at 90 at expiration, listeners. If you bought the par put, the 100 strike put, you get a payout of $10. So that put would be worth $10. Now, in this floating strike look-back put that they're talking about in this article, a bit of a different story. The strike floats. They look back over the lifetime of that option, and they give you the strike at the maximum price for where the underlying was. So in this scenario, it got all the way up to 120 before coming back to Earth. So they're going to strike you at 120 versus 100. So you could just see the difference is pretty obvious. $10 versus $30, 3x the payout. It sounds like it's too good to be true, Mr. Dan, according to this analyst here from, I think it was Citigroup. It only cost you 0.4% more. What say you to that, Dan?
Boy, yeah, I would like to see somebody offer that to me at 0.4% higher. That just doesn't really seem right. I mean, I gotta believe that there's a lot of other variables involved there. You know, maybe if it's a 1 week option, 0.4% higher is one thing, but if it's a 1 year option, can't be the case. Couldn't be the case.
Yeah, people are already complaining that your plain vanilla puts are too expensive, Dan. They're not going to give you this magical optimal payout for 0.4% more, Dan.
Yeah.
I get it. The extra premium they're calculating is based on implied vol, and implied vol right now is at the lowest it's been in quite some time. So from that perspective, historically, and that's what they're saying in the article, looking back over time, that additional premium is the lowest it's ever been. Doesn't mean it's cheap. No brokerage house, no large firm is going to give you an optimal payout for a nominal fee. That just doesn't make sense. So again, I would take some of that with a huge grain of salt. Also, the fact on top of it that for the lion's share of you listening to this, unless you're a large institution or can put up some decent size so that when you contact that firm to quote these, because these are OTC, these are all bespoke options, listeners. So you're going to pay for that as well. The spread is going to be, shall we say, wide on these options. So that in and of itself is going to be reflecting some of the cost. So there's a lot that's baked into this. But that said, it is an intriguing concept, and it's making its way out to places like Bloomberg. So our listeners are starting to encounter it. Let's go the other way as well. This is the less common look back, but also one you might encounter when you're looking out there. This is a fixed strike look back. So same deal. Stock starts at $100 in our example here. And that's where you buy your put. Your strike is fixed at the onset. 100 is your strike. Kind of like a similar put. You know, you buy a 100 strike put, and that's what you get. That's your fixed strike. Now, in this example, the stock kind of wanders a little bit. It starts at 100, drifts up to 110, then drifts below your strike to 95. So now your put's $5 in the money. Then it drops to 85. Now your put's $15 in the money, looking a little better. Then back up to 90 before closing at expiration at $92. So the traditional put, obviously you bought the par put. It's going to go out, stock at 92, going to go out worth $8. In this fixed strike look back, they're going to give you the look back on the underlying price. So they're going to give you the lowest that the underlying price was and give you that max payout instead. So in our example, the stock got down to $85 before rallying back up to 92. If you own the regular put, that $7 rally, that's just gone. You eat that. But in this example, they give that to you. So you get $15 for the value of your put versus $8. So nearly a 2x increase in payout out there. So again, there is no free lunch, no brokerage house, no large Goldman. I don't care who you call up. It's not going to give that to you for a nominal fee. They're going to give you max payout, but they're going to charge you for the privilege. So again, I haven't priced one of these up recently, so I can't say for certain that level they're quoting in the article, whether that's accurate or not. I think the theory behind it is sound. Low vol means the extra premium they're tacking on is going to be the lowest it probably has been in some time, but it's still an extra premium on top of an already illiquid OTC put that you are quoting bespoke for yourself. So you're going to have a hugely wide spread, which is going to be a lot of the cost. And then on top of that, they're going to tack on some fee for this extra max payout percentage. So you are going to pay for this regardless of what the article says. And also, it's not really accessible to the lion's share of you out there. But that is something we have cooking right now, this a lot of interest in exotics. Dan, what are your thoughts here on lookbacks from a floating and a fixed strike perspective, sir?
It provides you some pretty interesting advantages, because if you think about it, if you buy a put, just a straight vanilla put, which, by the way, I do want to just digress for a second here to talk about the phrase plain vanilla, because I feel that is a slap in the face of vanilla, because vanilla is indeed a bona fide actual flavor. It is not plain. It is a very specific flavor, and I like it. I like it.
You seem like a guy who would like vanilla. That makes sense to me now. It all's coming together, sir.
I do. I mean, don't get me wrong. I like my cookies and cream. There's some of the Ben and Jerry's flavors that I really like, but
I can see you as a plain tofu ice cream guy. Just no flavor at all. Just plain tofu.
Oh, no tofu. No tofu in pretty much any scenario. Anyway, yeah. So if you think about it, like one of the ways that you prosper by buying a put is you have to sell it at some point. And with the latter version of the look back put that you described, where you get wherever the stock got down to, you get to sell it at that price. It's kind of like what you're paying for is being able to exit at the perfect price. I mean, it is what you're paying for, is being able to exit at the perfect price, which no human ever does. And so paying something extra for that is surely very worth it. But like anything else, how much extra you have to pay for that, value versus price, that's the rub. That's the rub.
I vary on the utility of Bloomberg even reporting on this kind of. That's one of the reasons why I haven't really talked about it. I've thought about adding exotics into the show many times over the years, and for a variety of reasons we have it, Dan, because they're not really accessible to the lion's share of the listeners. They are exotic, as we say, so they're kind of intimidating. The pricing is kind of wonky, and they're expensive. So I mean, there's not a lot of utility. So the way Bloomberg wrote their article, what was the title of that? Traders hedging stocks at record highs dabble in exotic options. If you just look at that headline, you're thinking, oh, the mom and pop retail are dabbling in exotic, right? Because that's kind of the implication of that, when of course you read into it, and of course it's large institutions who are doing this. So again, that kind of limits the utility there. But interesting stuff nonetheless. If we're talking just the interesting theoretical value of them, Dan, it certainly is intriguing from that perspective. And hey, I wouldn't mind someone telling me, hey, I'll give you max payout for only 0.4% more. I'll take that any day of the week, sir.
Yeah, I mean, yeah, that is definitely some valuable stuff there. But yeah, I mean, that is the thing, is it's not really democratized. It's sort of, I don't know what the opposite of that, oligarchized or something, where the little old lady from Iowa in her bunny slippers who wants to trade the two lots of these look back puts, it ain't gonna happen. You got to be pretty well capitalized, and you got to really know what you're doing too. I mean, are you overpaying for it? Like, I mean, we've talked about this. I mean, we could just talk about it with vanilla puts. Like, hey, I think the stock's going down. I'm going to buy puts to protect myself. So hit the button, buy puts, done. No, like, you have to look at what the price is and see if it's actually worth paying that premium, where the word comes from, right? Extra for that. And so I don't know. I mean, it is a strange article for Bloomberg to report on, because it serves a much smaller number of people, a number of individuals, because A, you got to be super capitalized, and B, you better know what you're doing, because geez, I mean, I wouldn't just trust any firm or any person who works at a firm just to say, oh, trust me, this is better, you know? So yeah, there's a lot that goes into being the ideal customer for something like this.
Yeah, and outside of that brief window in April when stocks were whipsawing all over the place, you still would have lost money on all these lookbacks as well. Stocks didn't really go down for the lion's share of the last few years. For most of these periods, you would have been paying extra for these lookback puts. So you would have just been paying more and had pretty much the same outcome most of the time. Would have looked pretty good around April 8th, don't get me wrong. But outside of those scenarios where the stock was just whipsawing like crazy, outside of those, you probably still would have just given up a lot to the options gods buying these puts at the end of the day. Let's keep rolling out there to see what we have on the docket in terms of you folks and our questions of the week. Last week, even though we weren't live, we still hit you with the fun question of the week, which was quite simply, which handle will VIX be closer to at the end of August? It was a very straightforward one, Dan. 15 or 20, we asked our folks. And our audience, they were kind of split, which again is what makes a market. VIX was hanging out towards the middle of that range when we posted, obviously closer to the lower end of that range now. And Dan, the 20 took it ever so slightly, 53.5% of the audience saying VIX will close August closer to 20 than to 15, 46.5% going the other way. Obviously, we know right now where VIX is hanging out, closer to that 15 handle. But Dan, what are your thoughts on this?
When did you initially ask this question?
We asked this last week.
Oh, geez, last week? Yeah, I mean, I do believe that volatility will be higher, but I also know that I can't predict the future. So if you ask me today, I'm going with 15, even though I do think that volatility, I think it's weird that volatility is down here, but that doesn't stop it from being down here. And, hey, even though stocks from a valuation standpoint are super overpriced, they can be more overpriced and volatility can go lower. So I would say 15 just because statistically that's the right answer, but I would want to say 20. I feel it should be 20.
So you're feeling what our audience is putting down. There you go. So our audience is leaning that way as well this week, Dan, because we asked them on the Monday Option Block show, which you still have 1 point in our Option Block Trivia Challenge. I rub that into Mike and Andrew's face every week on that show. I'm like, Dan still is in third place. He only came on once, and he got 1 point. And that causes them no end of ire and umbrage, sir. So it's fun for me, and I'm sure fun for you. But this week on the show, we noticed a big block of 30,000 of the August 25 calls expiring next week, listeners, going up for 25 cents, or 25 for 25, Dan. 30,000 times, so decent-sized print. We said to our audience, quite simply, 25 cents for the 25s. You want to buy them or do you want to sell them? And 60%, Dan, said, I will buy those bad boys. 40% said sold to you. 25 does seem like a distant blip in the rearview mirror right now. By next Wednesday, that's where we're going out. But that said, Dan, what do you think? Our audience, 60% want to buy these 25s for 25?
I mean, I don't want to play in that pool either way. The old gun to my head question, I guess I got to sell them, but geez Louise. I mean, September is historically the worst month for stocks, if I remember my market trivia correctly. You have to talk to my friend Jeff Hirsch on that one to be sure, but yeah, I don't know, man. Seeing 25 by a week from today, I don't know, man.
That seems like a heavy lift. Then again, we are just one tweet away from something like that, sir. So, yeah, usually we give a third option in these to say, hey, maybe you want to sell them as part of a vertical instead. Give people that out because people don't want to naked sell, anything in VIX these. I get that. But last week, we were just buy them or sell them, Dan. We were just go to the bathroom or get off the pot, as the kids say colloquially there. All right, let's keep rolling. Let's go out to this is why the video is good. Your face. I love when I tweak Dan and he responds. All right, let's keep rolling. Our question of the week this week, listeners, is again we're in earnings season, listeners. So if you like a little bit of earnings fluff, a little bit of earnings vol, we got some for you, including some big names popping off this week. We asked you, hey, which earnings names are you planning to trade options on this week. We gave you 3 choices, and then, of course, the infamous other. We gave them Circle, AMAT, and CoreWeave, Dan. Which one of those, if you have a choice, do you think you'd like to trade? B, which one do you think is winning? And then, or maybe C, you have an other you want to add to the list. Have at it, sir.
I would not want to trade any of those. I mean, especially the ones that are newer, you know, I mean, you're trading something like CoreWeave. I mean, how long has that sucker been listed? Not that long. There's not that much of a history of the options being able to analyze the straddle. And most of my earnings trades are selling premium, have historically been selling premium. And I just don't like selling premium in these super volatile names. I mean, you can make money on them when the options are overpriced still. But it's just such a crapshoot, especially when there's so little history with some of these. I don't want to trade any of them. And geez, I don't know. It's hard to trade. I don't even want to speculate on what our audience would have said. I don't know. It's tough.
Yeah, it's fun when we're crunching the numbers, and we have a lot of earnings data for all these names, but names like Circle, you're right, we have zero history, Dan. This is their first announcement, so it's kind of hard to crunch the numbers when there are no numbers. That said, Dan, as of the start of the show, let's see if it's changed. No, it has not changed. Circle is taking it right now, 45.2%. They had a pretty decent report earlier this week, and they rallied off. A lot of our pro members were looking at some downside puts to do the old premium harvesting in out there. Those would have worked out. CoreWeave, number 2, 38.7%. Only 9.7% for AMAT, 6.5% for other. You know, if you choose other, you're supposed to tell us what your other is. And we don't have a lot of, everyone's just choosing other, but they're not telling us what that is, Dan. So I'm going to write in, I'm going to choose all of them are just choosing IBM because that's the hot, sexy stuff with the kids these days. Everybody loves a little bit of Beamer. But Mr. Dan, I've been remiss in delaying you. Do you think you have a MTM question of the week for the kids, sir?
Yes, I can do that, of course.
All right, then it is time, listeners, for the Market Taker question of the week.
And now, it's the moment you've been waiting for. It's time for the Market Taker question of the week.
All right, Mr. P, what you got for the kids this week?
Yeah, I just got this question late last week. And speaking of earnings have been getting more volatile, meaning that, well, I know Matt from ORATS likes to track the straddle price versus the gaps, and basically the gaps have been getting bigger lately. There's just been more volatility than we experienced in the past. And as I just mentioned, my earnings system is trading time spreads, and there's a lot of math and such behind it. So I don't trade it on everything. In fact, I trade on very few when everything lines up just right. So the question was, Dan, is the earnings system, total earnings domination, is that still viable now with greater earnings gaps? And the answer is yes. We just have to account for that. And so basically we take fewer earnings trades and, you know, maybe trade them a little bit smaller too. But yeah, it's absolutely still viable. And the times where I do take straddles, which are very few and far between, because those can sure be tricky, you know, I end up looking at those as possibilities a little bit more often.
You have been Mr. Straddle lately. You're just, you're straddle crazy. So I guess that's just a sign of the times we are all living in, listeners. All right, Dan, you survived another run through of the old drill instructor proving ground. Did you have fun this week, sir?
I did. Yeah, it was nice to talk about some topics we haven't talked about before.
Yeah, that's the nice thing about the exotics. I've held off on them for a long time, but we have not really delved into them in the 12, 13 plus year history of this show. So there are many more listeners than just the lookbacks. I don't know, Dan, maybe we'll sprinkle in some exotics into future episodes from time to time. What do you think?
Yeah, we can always do that. That sounds great.
All right, so look forward to a little bit more exotics. You like your knockouts, your barrier options, listeners, maybe a little knock-in, all sorts of fun. Maybe we'll roll with some of that in future episodes. In the meantime, Dan, if folks want to roll with what you got cooking over there at MTM, where should they go? What should they do?
Sure, make your way on over to markettaker.com. Market like stock market, taker like take what is rightfully yours, 2 T's in a row. Markettaker.com, and we have free classes. We have free access to a number of things on our website. Just go to the top right-hand corner and click on Join Free.
There you go. Join free listeners. Check them out over there, MTM. Don't forget the second T for Theta. And that's going to do it for the old OBC. Not going to do it on the network today. Not by a long shot. You think the producers are letting me off with one show? No, listeners. We're a trifecta a day shop these days. Listen, coming back to you in a little bit, talking all things futures. I believe I will be joined by the folks from Tradier on the Futures Rundown, so stay tuned for that. And then after that, after the bell, one final time for the day, we come back to talk everything hot options on the old Thor show, the Hot Options Report, all the hot stuff in the world of options. We break it all down. Yet another reason, if you're just listening to OBC, I know there's a handful of you out there that do. Hey, we love y'all. But make sure you're getting the full network. You're really missing out on a ton of great stuff. And then, of course, speaking of missing out, if you want to go above and beyond, perhaps you want to join us for some awesome pro Q&As. You want to talk unusual activity on Friday with Options Oddities. You want to get early access to a whole bunch of stuff, other exclusives, live streams, and, of course, win fabulous prizes. TheOptionsInsider.com/pro is the place to go to learn more. Back again in a little bit with the Futures Rundown. Then, of course, Thor. And we're back again with our usual array of content until we're back next week. We'll know where VIX goes out then with another episode of Options Bootcamp. Stay safe out there, everybody.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.